a couple things that overlapped. We had a big iceberg. Don't worry about all the noise and stuff you see overlapping. Just follow the things that I'm going to point out. This red is a big iceberg. 175 he's showing, so he's probably got a few thousand. It's generally bearish if we go up, fill them, and then cross back through them. But a couple things happen. It gets a big short right in here. Big short comes in, which shows us we're probably going to pop, and we do. We pop and we fill them. All right. And they get through them. All right. Short comes in, then goes away, and then we cross back through the south side of it. Now, at the time, I says, "Hey, listen, that's a good, this is a good short or bearish opportunity. I just don't like the amount of shorts that are short right there. If we could just get some longs to counterbalance it, or they go away." And sure enough, right there, you see this green come out. That was the moment to say, if you're not short already, this is the moment either to get short or certainly not be long. But this is we should slide down. All right, at least a little bit when these little Johnnies get long. And maybe it was people listening to this video. You got long there, and you take immediate heat as the market breaks down, and then uses it as overhead resistance. Okay, that's not a coincidence. And these are all the things that we're able to anticipate because we're able to see it. So then as we go along, you see those shorts come in. I'm just keep your eyes focused on this or this area right there. So we're just chopping sideways. We're looking for the next move. Yeah, some longs come in like right there. Not that readable of a moment. Oh, I clicked on accident. Not that obvious of some downside, but whatever. It comes off a little bit. Again, there's some longs that come in, but some shorts come in, and it would just go sideways, just go sideways. Something that slaps you in the face right in here. You already had this long as resistance, and then you had some more longs come in to help push it lower. All right. So we're just going sideways, though. We're not breaking out. Not breaking out. Whoa. What happened there? Big longs come in. If you're looking to go short, it's what are you waiting for? And then more shorts or more longs rather are coming in to kind of validate more downside. Look at this big long comes in. We get below him. If he stays, we could go lower. You could see my arrow in the recording. Watch this. You'll see my arrow in the recording. Point to this guy here. As long as we stay below there, that's overhead resistance. It's bearish. So the whole point is anticipating seeing more longs come in to get short. See more longs to come in to get short. And it's not a coincidence when it goes. It's not random anymore. It's all about longs and shorts. If you look at, what could have called this breakout right here? Obviously, these longs that sneak in. When they're long and wrong, they're sellers. Longs are sellers. Remember that. So if you're sitting there watching this video saying, well, what does it matter if they're long? Because when someone's long, they're a seller, including you. So we come down here, we have like a fight, almost an equal amount of shorts and longs at this price of 50, right? And so it's like bearish below it, maybe bullish above it. And we stay below it. You see me reminding people writing this up in here, longs equal sellers, just to continue the repetition of, why we're looking at this stuff. Man, look at all those longs get in. We head lower. The top of this is going to be overhead resistance. And when it is, it's not a coincidence. When the longs go away, then we could rally. When they fade back down. So it's just boom. When this long comes in, these longs are already in. Just a better chance to take out these green icebergs and head south. That's all. That's all that means. All about probabilities. So when you're looking to time your trades, when to get in, when to get out, I get that question years ago. I'd get that more. Now with this tool, instead of having to read a little deeper into delta stuff and footprint stuff, it's much easier now taking the MBO data and determining when people are putting in a buy order to get long or putting in a sell order to get short. We are now able to see the intent of the order, position opening up. So this is the whole this is the whole shooting match. If you look at, like, we had a bottom that came in, and I happened to walk away from my desk. And so I came back, and the bottom was, I think, right here, right there. When I say a bottom, it quickly ran up, and I was away. So I stopped the recording. I said, well, what was missed down here? What could we have seen here to qualify that it was going to go up? So I rewound it, and some people had said this open short position when we get above him. Okay. But there were less longs. Some of these longs got filed down. All right. And if you look at this, you could see it crosses back over this green iceberg. That's bullish. Gets above this red, and some of the greens went away. And then it pops. So again, what are you trying to look for with respect to order flow to find a bottom? And in this case, it's not hindsight's 2020. It's all right. We have what you need to look for. Now you have to anticipate it. I was talking to people when we were doing the room, and we're still in the room, but during this highlight, if the analogy is, if you're a driver and you're a good driver, it's because you're good at anticipating what other people might do. You can't control what other people might do, but you can anticipate it. It's important to see if the guy slams on his brakes in front of you, but it might be too late if you weren't anticipating it. You have a better job at stopping and not slamming into him. If you anticipated he could have slammed on his brakes because someone was kind of cutting him off or might turn left in front of him. You're anticipating a couple steps out. You're a safer driver. As a trader, you can't just say, all right, I see these longs got shaved and they went down. You have to anticipate maybe seeing the longs go away. You have to anticipate maybe seeing a big short come in, so that when you see it, you could react quicker. And that's the definition of slowing things down. That's the definition of understanding something and missing less, because you now understand what you're supposed to see. If you are going to predict it's going to rain because you felt a couple drops, it's too late. If you're going to predict it's going to rain because you see dark gray clouds out west, that's a little better, right? But stop predicting it's going to rain after it's raining. Stop predicting price is going to go lower because it's lower. Price doesn't predict price. You cannot say it's weak. I mean, a fifth grader could tell you it's weak after it broke. You have to start anticipating a move by anticipating what you're seeing, and that's anticipating people being stuck long and stuck short. Have a safe weekend.